Welcome back, everyone. It's me. US Core PCE inflation is expected to rise 2.9% in August from a year ago, marking its highest year-over-year increase since April of 21. Consensus is at 2.8%, and actual could be higher. The data is due out tomorrow morning at 8:30 a.m. Eastern. For those who don't know, the Core PCE is the Federal Reserve's preferred measure of inflation as it excludes more volatile food and energy prices. The central bank targets an inflation rate of 2%, and in July, the 3-month annualized rate of core PCE inflation came in at 2.6%, which means that it's likely that we will see another 2.9% year-over-year increase in August. However, what the Fed and the markets are really focused on is whether there are signs of an acceleration or a deceleration in the rate of inflation. If inflation comes in hotter than expected, then that would be a negative for risk assets like stocks and cryptocurrencies, and a positive for the dollar. And vice versa, if inflation comes in cooler than expected, then that would be a positive for risk assets and a negative for the dollar. In the case of the dollar, the currency has already priced in a 2.9% year-over-year increase in core PCE inflation. So unless inflation comes in significantly higher than expected, we probably won't see much of a reaction in the dollar. However, the markets are still uncertain about the outlook for monetary policy, and this is because we have mixed signals coming from Fed officials. On the one hand, we have Boston Fed President Ken Montgomery, who just recently said that he does not see a compelling case for a rate hike in September and that the Fed should wait until there are clear signs of further progress in reducing inflation. On the other hand, we have Richmond Fed President Tom Barkin, who said this week that there is still more work to do to get inflation down and that the central bank needs to keep policy restrictive to make sure that price pressures subside. Financial markets currently see a 55% chance of a September rate hike and a 55% chance of a rate cut in the fourth quarter. And these probabilities have actually been coming down in recent days, so the market is now fully pricing in a 2.9% year-over-year increase in core PCE inflation, and the market is starting to price in the chance of an early rate cut. However, this is only because we've seen a significant sell-off in treasuries over the past few days, which has caused treasury yields to rise. And the reason why this is important is because the 10-year yield is unmoved by today's CPI report, which means that the market is starting to price in the chance of an early rate cut. But if inflation comes in higher than expected tomorrow, then that would push the 10-year yield even higher, and that would cause the Fed to keep rates higher for longer. So to sum things up, the market is currently in a state of limbo and is waiting for more clarity from the Fed. And this is why we are seeing such a strong correlation between the 10-year yield and stock prices. When the 10-year yield rises, stock prices fall and vice versa. If you enjoyed this video, then please hit the like button. Thanks for watching.